All right, got a little update here. A couple of days ago, we had, or was it yesterday, Federal Reserve Chairman Ben Bernanke. Man, the old economy is not looking so good after all. Imagine that. He said progress in reducing unemployment is likely to be frustratingly slow, and repeated that the central bank is ready to take further action to boost the recovery. This report also contains comments from Republican U.S. Senator Bob Corker of Tennessee and David Vitter of Louisiana. We haven't really come to a specific choice at this point, but we are looking for ways to address the weakness in the economy should more action be needed to promote a sustained recovery in the labor market, Bernanke said. So, further action. What is further action? Quantitative easing 3? What are we talking about? The U.S. economy has continued to recover. I guess they claim. I don't really see it. But economic activity appears to have decelerated somewhat during the first half of this year, Ben Bernanke said. So the U.S. economy has continued to recover. Since this whole quantitative easing in 2008, it has continued to recover. But economic activity appears to have decelerated somewhat during the first half of the year. So you don't suppose they'll say, well, we were in recovery mode, and then all of a sudden we don't know what happened, but the stats started looking bad, so we exited recovery mode and went to quantitative easing 3 to try to fix things. The Fed is, quote, prepared to take further action as appropriate to promote a stronger economy. And then we have, could this be a game changer for precious metals? Got some of this from Zero Hedge. Bernanke reiterated once again the stance of the Fed is prepared to take further action should the economic conditions worsen, but offered no clue on the timing of such action. We all believe, myself included, quantitative easing 3 would be coming. Now, I will say, I thought it would be here a little earlier, but I think it's coming nonetheless. Market participants and traders will wait for Bernanke's testimony at 1400 or 2 o'clock today for more clues, and I think that was actually today, which I haven't got an update on. But those with a more long-term horizon will again diversify on the dip. In other words, precious metals prices are down right now, you should be buying. Bullish for gold was the Fed chairman's admission that policymakers are studying options for further easing that could be deployed. Tools available include further purchases of assets, which really aren't assets, more like purchases of garbage that they just claim as an asset, reducing the interest rate on bank reserves kept at the Federal Reserve, and altering its communications on the outlook for rates. Now, when it says reducing the interest rate on bank reserves kept at the Federal Reserve, what they're talking about is all this money that we, you and I, gave the banks through a forced bailout. They took the money, realized we don't want to lend it to people because we're defaulting partially because people can't pay their loans back. Of course, they caused that problem by inflating the housing and everything. They, the bankers. And now people are defaulting. Well, they don't like defaults. So surely we don't want to give loans out. So what can we do? We'll get the money, and I've said this before. We'll get it near 0% from the Fed, i.e. too big to fail bailouts. And then we'll take and turn around and park it back in the Fed at like 1% interest or whatever, some interest rate higher than what they borrowed it for. They borrowed it at 0.25 or damn near zero. And then they park it back at the Fed at higher than that, maybe a single percentage point, or maybe 0.75. If you have billions and billions of dollars parked at the Fed and you're making even half of a percent interest on billions of dollars, tens of billions, half a percent's going to add up to quite a little bit of money. So, the dollar index, which is a gauge against 6 counterparts, fell for a 4th day in a row. Gold may also receive safe haven buying from the LIBOR scandal and crisis which deepened yesterday when Bernanke's testimony conflicted with the Bank of England's King, and Bernanke appeared to admit that Fed employees were involved in the manipulation of LIBOR. Bernanke said yesterday that, quote, in 2008, there was an active effort to report to all relevant policymakers, while King had said that the first I knew of the alleged wrongdoing was 2 weeks ago. Yeah, I don't think so. Citi, Bank of America, and JP Morgan appear to be set to be dragged into the LIBOR-gate scandal as Congress is expanding the LIBOR probe to the big three U.S. domestic banks. Can't wait to see where that leads. Probably nowhere. But at least they're putting the freaking spotlight on them. Also extremely bullish for gold was Bernanke's admission that LIBOR is, quote, structurally flawed, and an international effort would be needed to restore the rate's credibility as the leading benchmark for mortgages, derivatives, and corporate lending around the world. So you think an international effort is going to be needed to restore the, quote, credibility of something in which the non-credible banks, the top banks, were the ones who set that to begin with. So you have the mobsters, or banksters, setting the rates, but you're not mentioning that we need to clean out the bankers in order for the LIBOR to be, have its credibility put back into, where it needs to be. Why not? Why aren't you mentioning that? Why are you just saying that it's structurally flawed? There's a structuring problem. No, it's not a structuring problem. Just like there was no structuring problem with the World Trade Center Twin Towers. But when you place explosives, nanothermite by the way, into these buildings, and they fall from top to bottom at the speed of gravity pulling anything out of the air, which is free fall speed, meaning there's no resistance below it, which means we were lied to on 9/11 because the buildings fell at free fall speed, meaning no other floors slowed it down, which is impossible. Yet, my example, a bridge is structurally sound. Twin Towers were structurally sound until someone started screwing with it, i.e. the bankers, right? And in this case, the bankers screwed with the LIBOR. They're the ones who set the rate. So if you have 9 guys from all different 9 banks, let's say, and they're all responsible for setting these rates, and they all agree to rig them, it's not a problem with the system. It's a problem with the people you've allowed to rig the system, which, of course, always, for some reason, just always goes back to these bankers. Incredible. Global commodity prices. Year to date, food staples such as corn have risen by 18%. Soybeans have surged 32%. Isn't that amazing? Gold and silver, nah, no surging there. Those are commodities. But corn and soybeans, they surged. Bread is set to get even more expensive in the coming months as wheat prices have also surged 34% year to date. It is worth remembering that soaring food and especially food prices led to the Arab Spring. Allegedly, that's what they think. No. And part of this is from Bloomberg. So no, the Arab Spring had nothing to do with the food prices. And the various popular revolutions in the Middle East and North Africa. Hungry people do not stay hungry for long. People suffering from inflation and receiving very low yields on deposits in unsound banks, which by the way is all banks, not just unsound, because they're all unsound. They're all technically bankrupt the day they open the doors because they all practice fractional reserve lending. So people suffering from inflation and receiving very low yields on deposits in unsound banks will continue to turn to gold as a store of value. Game changer for gold in UK as new regulation favors gold. What's this? Did you guys approve this through Bernanke? How about little Timmy Geithner? No? What is this? Gold as an investment or savings mechanism has been frowned upon by the financial services industry in the UK and internationally for many, many, many years. This was due to the bursting of the gold bubble in 1980, when Paul Volcker, then head of the chairman, increased interest rates to nearly 20%. The poor performance of gold in the 1980s and 90s because of this, and the superior performance of cash, bonds, and equities in that 20-year period. So naturally, you raise the interest rates on paper products, all of a sudden investment demand flies right into there. Like letting the drain out of your bathtub when it's full. It's going to go right down the drain. It's going to flood to that drain hole. And oh my God, gold, as they tried to smash it because gold was skyrocketing from 1970 to upwards when we finally got to 1980, it was really going crazy. Same with silver. We got to put a cap on that. Let's open up the door over here, which is called this paper crap. Let's jack the interest rates way up, and we'll take all the investor demand away from precious metals and dump it into our system. And that's what they did. And it lasted for damn near, lasted for 20 years plus, as it said. It was also due to the fact that gold bullion was not lucrative for financial advisors and financial institutions such as stockbrokers and banks. Gold bullion is bought as a long-term investment of store value and as financial insurance. It is normally bought and kept and owned by the owner for a long time, even passing it on to children. This means that financial institutions do not make continuing commissions, which is their stock in trade, by the way. Gold bullion is also a very low margin business when compared to structured products and the many investment products with non-transparent and often very high charges and fees. That is so true. There's no money to be made with these financial institutions if you're buying and selling gold. Think about it. You go and buy, a TV. Let's say a 42-inch TV right now, nice little LCD. Say you pick it up for $500. Could you imagine finding out that the manufacturer of that TV, who's selling it directly to you, there's not really a middleman, really. There may be a middleman, but it doesn't matter. Put it this way: they sell it directly to you for like $450, or excuse me, it cost them $450. They're selling it to you for $500. They're taking $450 to turn into to make $50 on it. Probably even less than that when you look at. I haven't actually done the percentage math on this one, but what I'm getting at, for example, is a silver coin, and let's say right now spot price is $30, and you can get a regular old coin for $1 over spot price. Sure, you can get an eagle for $2.50 to $3 right now, etc. But the point of this example, $30 coin, silver coin, $1 over spot. That's it. That person who sold that coin, i.e. APMEX, Monex, etc., Gainesville coins, they didn't get that for less than spot. They're paying spot price for it when they place that order. So they just took something that cost them $30 to make a whopping almost nothing $1 profit. Now, normal markup in retail and all kinds of stuff is 50%, sometimes 100%. So a 100% markup of $30 would be $60. A 50% markup of $30 would be $45. That's typical. When you go and buy something, you should see a 50% markup normally. These guys can't sell that. These financiers, right? These funds and all this crap, financial institutions and financial advisors, they can't sell you a piece of gold, or in this case silver, and make $1 on it one time and then never see you again and hope you keep coming back and buying it so he can make his $1. Oh, no. He's got to have financial products, and they need to make several percentages points off of everything that you do, and they're going to claim, we're going to invest this for you. Just give us your money, and the more you keep giving us, the more we'll keep investing, and we'll keep slicing off the top our percentage the whole time. So for their whole livelihood to even exist, they got to have these paper products. And these paper products are failing. And when the big epic fail comes, that's when you start to see stories of these financial institutions, hedge funds, you name it, investment companies, CEO committed suicide, hung, jumped out of the building, jumped out of the windows, etc. Happens every time. Those of us sitting back with some of these are silver eagles in here. We're not going to be jumping out of anything. As a matter of fact, we're not going to be jumping out and down to kill ourselves. We're actually going to be jumping up and down for joy, standing still where we're at in the same spot, jumping up and down, because that's going to skyrocket in price. It's a real asset. It's not a piece of paper that says somewhere you've got some stocks and bonds over here that millions of other people also have. And some little financial news came out today that destroyed the entire stock market. Everybody put their sell orders in, and all the big boys with their computer systems automatically sold first. You're going to not be able to call your HR department at work to tell them to call the person that's got your 401k in their possession or their control. It's after hours. They're closed. Sorry. Sell. Oh, wait a minute. I can't tell you to sell. Wait a minute. Hey, even if you want to sell, you can't sell. It's not like you're calling your broker. Hey, go ahead and pull my money out on the side. I want to sit this one out. You can't. Now, you can stop contributing to your 401k, but it's going to sit there in these little investments. And what happens when those investments die? You can't even call and say, take it out now, leave it alone. Now I don't know, so I can't quote this for sure, if you were to contact your 401k company and tell them, I've got $50,000 in my 401k and I've got it in these 3 different funds. Can you take it out of those 3 funds and just sit it like in a bank account for me for the time being? I don't know if you can do that. I don't think you can. I think it has to stay in these funds. Again, that company won't make anything if it's sitting there unless they're going to charge you a fee to do so. And I don't think they do that. I think it's just simply, no, you can't do that. You have to leave it in these funds. Whatever happens, happens. But we have less, volatile funds. We have the safe ones. They don't give a lot of interest, but they're the safe ones. And you may find out at the end of the day, it doesn't matter whether they're safe, medium risk, or high risk. It's a piece of paper. It's garbage. So, the poor performance of the financial services industry with a series of misspelling and other scandals, and the abject failure of much of the industry to have the fiduciary interest of their clients at heart, means that the UK's FSA is set to bring in legislation that will protect the retail investment public. The FSA, which is the Financial Services Authority, their primary role is to make retail markets for financial products and services work more effectively, and so help retail customers to get a fair deal. In June 2006, the FSA created its Retail Distribution Review Program, which they are enacting in order to enhance consumer confidence in the retail investment market. The RDR has a target for full implementation by December 31st, 2012, last day of this year. The RDR is expected to have a significant impact on the way in which financial services are delivered to retail investors in the UK. The primary delivery mechanism of financial services to retail customers is via approximately 30,000 independent financial advisors who are authorized and regulated by the FSA. They are expected to bear the brunt of the force of the RDR. Gold bullion is set to benefit from the axing of commissions for IFAs, and the implementation of the RDR should be regarded as a game changer for gold as an investment in the UK, according to the World Gold Council. And strangely enough, just before that happens, we have our position limits kicking into gear, which I think should be around, let's see, when they technically are going to put this in, July, August, September, sometime around October or November. However, remember these beginning of the story, commodity prices 34% higher. Where was the other one? 34% higher and 18% higher for soybeans, and 32% for soybeans, and corn was 18%, etc. You don't suppose all this is known well in advance by these guys. And again, I'm bringing it up again, 35% margin hike, CFTC on all commodities across the board. Should be taking place sometime in early August. That's when the 90-day extension that the CFTC gave us, or via the CME group, before they have to implement it. So we're going to have August here shortly, another couple weeks. And I'm still waiting to see what happens with this margin hike. But with these commodities exploding in price right now, again, these are food, but they're still traded just like gold and silver as commodities. You don't suppose they're going to put a little clamp down on that explosion of food prices, do you? by a perfectly timed 35% margin hike across the board for all commodities coming in August, just before position limits kick in for silver and some other commodities. And again, it's just a spot month position limits to start with. So I don't know if I'm real excited about that just yet. It's when the non-spot month rule kicks in a whole year later that will probably excite me, because then both are in place. And then I think the manipulation by JP Morgan would be completely gone. So, having said that, it's just amazing how you look at this as a timeline, and they're going to drop the prices if they do this 35% margin hike, and I've read nothing that says they shouldn't or won't. They got a 90-day extension. We got a 90-day extension, actually. So that'll happen. Then the position limit for the spot month will kick in shortly thereafter. Then we have this thing in December kicking in. This new rules. Man, I'm just saying, I think they're going to smash everything down one last time, including gold and silver. And then maybe the gates will start to open up. And again, if it's not opening up for gold and silver after the spot month rule kicks in, it should be after the final rule kicks in for the non-spot months, which means they can't have an enormous amount of positions in the month we're in, which is the spot month, or any other month out for years to come, which is why I think the spot month isn't going to do much, because they can get out of the spot month and comply with the rule change, the position limits, but then in the non-spot months, just load the boat back up with paper contracts. All they have to do is sell off massive amounts of paper contracts that are in the non-spot months with the same effect. They'll have plenty of sell orders with not enough buy orders. It'll cause all the prices of all months of silver, whatever, to go down. So I'm not excited yet. Having said that, with the WebBot data and stuff, man, there may be something coming out of left field that just doesn't care, and it's going to set precious metal prices to start going up, regardless of what they do. I don't know about that, but that's my 2 cents, and that's all I got for you.